All right, let's jump right into this explainer. Today, we're putting on our sell-side equity analyst hats to decode a really fascinating financial mystery. We're looking at CG Oncology, a company where the stock performance and the underlying fundamentals are, well, telling two completely different stories. We're going to see exactly why our traditional valuation models are totally failing us here and try to figure out what on earth the market is actually pricing in.
We're kicking off our investigation with an absolutely unbelievable number, a massive $5.878 billion market capitalization, with a recent closing price just under $70 a share and a 52-week low way down at $23. This equity has just skyrocketed. I mean, it's the kind of multi-billion-dollar valuation you'd typically expect to see attached to a mature company, right? One with predictable free cash flows, established market dominance, and maybe a long history of dividend payouts. But as we're about to see, CG Oncology is literally the exact opposite of that traditional profile. Just look at this stark contrast. You juxtapose that explosive 220% total return over the trailing 12 months against a staggering net loss of nearly $161 million. On one hand, you've got a year-to-date return approaching 68%, which is rewarding shareholders handsomely. But on the other hand, the bottom line is just bleeding cash at an alarming rate. It's a total return that completely defies standard logic when you place it right next to a net income line that is that deeply in the red. We've got a serious valuation paradox on our hands here.
So, the absolutely crucial question we need to investigate is this. How exactly does a company bleeding massive amounts of cash see its stock surge by over 200%? In a rational market, shouldn't those massive losses lead to a plunging stock price? What is the street seeing that the bottom line earnings are entirely missing? To answer this, we need to take a really hard look at the valuation tools we use as equity analysts, and honestly, recognize when we just need to throw those traditional tools right out the window.
Section 1. Stress testing the bottom line, where traditional models break. Let's see exactly why standard absolute valuation tools completely fall apart here. If you were sitting down trying to build a rigorous, fully documented stock valuation, utilizing a discounted cash flow analysis, an adjusted present value model, or even a sum of the parts valuation, you'd be stopped dead in your tracks. The source data shows a 0% dividend growth rate, so there is literally no dividend to discount for a DDM. You can't build a reliable present value of future cash flows when current free cash flow is profoundly negative. And you certainly can't value tax shields on debt using an APV model when there isn't any debt.
It's abundantly clear that traditional metrics are just broken for this specific profile. We've got a negative PE ratio of roughly -33, a negative price to free cash flow ratio of -42, and wow, an astonishing return on invested capital of negative 968%. That ROIC figure is particularly eye-opening. It essentially tells us that for every single dollar of capital invested in the business right now, they're burning through it at an accelerated, near tenfold rate. A traditional value investor would take one glance at these figures and immediately run for the hills.
But as forensic analysts, you know we don't just give up when the PE ratio goes negative or our DCF model spits out an error. When a bottom line is this deeply in the red, we typically pivot to relative valuation models. We look at revenue multiples to try and find some sort of fundamental floor. The most common tool here is the price-to-sales ratio. By temporarily ignoring those heavy costs of research, development, and scaling, we can measure exactly how much the market is willing to pay for each dollar of top-line revenue the company is actually bringing through the door. And this brilliantly illustrates the extreme nature of this equity. Their price-to-sales ratio is an astronomical 1,455. To give you some context on that, a healthy, high-growth tech or biotech peer might trade at 10, 20, maybe 30 times sales. But a PS ratio of over 1,400, that is almost unheard of. It tells us, point blank, that the current valuation is entirely divorced from present-day reality. It is being priced 100% on future, monumental expectations.
To put that staggering multiple into perspective, let's just look at the raw dollars. The market is valuing this firm at nearly $6 billion, despite it bringing in barely over $4 million in revenue over the last 12 months. Yeah, you heard that correctly. $6 billion in value for $4 million in sales. That massive gap is the very definition of a valuation built purely on potential and anticipated future cash flows rather than anything related to current operational output.
Section 2, a bulletproof balance sheet, surviving the cash burn. Any rational analyst is going to ask one immediate question at this point. How on earth do they keep the lights on and avoid bankruptcy with a negative $132 million free cash flow?
Well, we pivot our analyst's lens away from the income statement and over to the balance sheet. And here is the massive reveal, the smoking gun. CG Oncology carries absolutely zero debt, a zero debt-to-equity ratio. This is the ultimate trump card for an early-stage, high cash burn company. Because they aren't burdened by crushing interest payments or looming debt maturities, they are entirely insulated from the credit cycle and those interest rate shocks that typically wipe out emerging growth companies.
Now, check out these fortress-like liquidity metrics. A current ratio of over 24 means that for every single dollar of short-term liabilities they owe over the next year, they have nearly $25 in highly liquid short-term assets, presumably cash and short-term equivalents, just sitting in the bank ready to deploy. Their quick ratio is practically identical at 24.58. Bottom line, they have overwhelming liquidity to sustain that massive cash burn. They aren't going anywhere anytime soon. They've essentially bought themselves the most valuable asset in clinical development, time.
Section 3. The momentum story. Explosive revenue growth. So, with near-term survival guaranteed, the market is entirely focused on the future trajectory. And this is where we actually start to see the justification for that staggering multi-billion-dollar valuation. The market is buying the momentum.
Let's look at the timeframes here and see how this builds. Their explosive top-line growth is compounding at an incredible rate. We're talking a trailing 12-month revenue growth rate of nearly 255% and a 3-year compound annual growth rate of over 276%. This really highlights the sheer velocity of their emerging operations. Sure, the base number of $4 million is small, but the rate at which it's accelerating is exactly what growth investors are hunting for. It's not about where the revenue is today. It's about where this growth curve is going to put that revenue 3 to 5 years down the line.
And underneath all of that, the unit economics actually shows some real promise. They're maintaining a strong gross profit margin of over 62%. So the core operations, the actual revenues they are generating, are profitable on a gross basis. But they're making a conscious strategic decision to invest so heavily into their research, development, and clinical pipeline that their overall free cash flow drops to a negative $132 million. They are intentionally choosing cash burn today in exchange for market dominance tomorrow.
Section 4. The analyst's verdict. High risk, high reward. All right, let's wrap up our forensic investigation and deliver the final verdict on this incredibly unique equity. We've seen the massive 200+% returns, the total failure of our traditional absolute valuation models, those astronomical sales multiples, and the fortress balance sheet that makes this whole thing possible. This explainer proves that CG Oncology is completely untethered from current cash flow realities. Traditional fundamental models just break down here. You can't run an MPV or a DCF on a negative $132 million free cash flow, and you can't run a DDM with zero dividends. Instead, the market has assigned an unprecedented 1,455 price-to-sales ratio because it's utilizing the company's flawless zero-debt balance sheet as an absolute guarantee of runway. They're funding visionary breakthroughs, and the market is already pricing in a highly successful, fully scaled future. It is the ultimate high-risk, high-reward clinical play. Which leaves us with one final critical question for you. We've laid out the data exactly as it stands. You see the massive risks of the cash burn, for sure, but you also see the unparalleled safety net of zero debt and explosive top-line growth. So, as an investor, are you willing to buy into a high cash burn company where the multi-billion-dollar price tag relies entirely on the hope of tomorrow? It's a fascinating paradox, and it's exactly what makes the market so incredibly dynamic. Thanks for joining me on this deep dive into the numbers. Keep questioning the metrics, and I'll see you in the next explainer.